The Federal Reserve Bank has set a goal to bring inflation down to 2%. But what they've been realizing, especially in 2023, is that bringing inflation down all the way to 2% is much harder than what they originally thought. The way that the Federal Reserve Bank is working to bring inflation down to 2% is by, number one, raising interest rates, and then number two, by doing what they call quantitative tightening. Quantitative tightening is essentially getting some money off of their balance sheet, aka removing some of the money in our economic system. Well, what they're saying now is that this fight to bring inflation down is going to cause more economic pain than what they originally thought. Now, the reason why this is so interesting for you to understand and so important for you to understand is just the general trend of the Federal Reserve Bank's opinions about our economy and how things will progress. Because if you remember, when we first started seeing the quantitative easing and the money printing, everyone said, including the Federal Reserve Bank, our central bank, that none of this quantitative easing is going to cause any inflation. And then, of course, we saw some inflation that they said, well, it's nothing for you to worry about because this inflation is transitory. Well, not too long after that, the Federal Reserve Bank came out and said, okay, this inflation is not transitory, but we have it under control. Then the Federal Reserve Bank said, okay, you know what? We're going to have to raise interest rates to bring down inflation, but we don't have to worry about raising interest rates right now. We will start raising interest rates in the future. And then the Federal Reserve Bank said, okay, we're going to start raising interest rates right now, but we don't need to be that aggressive with raising interest rates. We can just raise interest rates by 0.25%. And then, not too long after that, the Federal Reserve Bank said that, okay, bringing inflation down is a lot harder than we thought. We need to increase significantly interest rates. That way we could cool down inflation. Now what we're seeing happen is the Federal Reserve Bank is saying, yeah, we still need to stay tough on this fight on inflation, and it might actually bring some economic pain. This is the first time now that the Federal Reserve Bank is saying that we could see some economic pain because of this fight on inflation, because up until, well, the early middle part of 2023, the Federal Reserve Bank kept saying that, one, inflation is not a problem, and then bringing inflation down would not cause any sort of economic pain. So now the question is, how much economic pain are we going to see? Because remember, in the beginning, the Fed said that we're not going to see any inflation. Then they said inflation was transitory. So the question is, are we really going to see a mild recession like the Federal Reserve Bank says? Are we going to see no recession, or are we going to see a more significant recession that maybe the Federal Reserve Bank doesn't anticipate just yet? And the way that you can start to understand this is just to think, what is it going to take to bring inflation down to 2%? Now, everything that I say is going to run on that premise. It's assuming that the Federal Reserve Bank is going to stick with their word of wanting to bring inflation down to 2%, because there's always a chance that the Federal Reserve Bank can pivot. And by pivot, I mean that they say, you know what? Inflation hasn't come down to 2% yet, but the economy, unemployment, jobs are becoming a bigger concern. So instead of working to bring inflation down, we, the Fed, are going to pivot and we're going to cut interest rates. That way we can stimulate and boost the economy, or we're going to print money that we can stimulate and boost the economy. The Fed could do that. If the Fed makes that sort of pivot, well, that could boost the economy in the short term, but then that would also make the inflation problem worse. And if that happens, that's going to completely change the trajectory of our economy, our currency, and really everything to do with building wealth, because, well, inflation is a real problem. And inflation disproportionately hurts people who are financially uneducated. It disproportionately hurts the poor. It disproportionately hurts the middle class. And it disproportionately benefits the wealthy and the investors, which is where you would see a bigger divide between the haves and the have-nots. So everything that I say from now on is going to be on the premise that the Fed is going to stick true with their word, with their promise of wanting to bring inflation down to 2%. That's what they have been saying for years now. So if the Fed wants to bring inflation down to 2%, what are their tools to do that? Well, the Federal Reserve Bank doesn't have fairy dust to bring inflation down. And in order to bring inflation down, they have to cool down demand. So now, to understand what that means, you got to understand what is inflation. Inflation comes from the word inflate. What are you inflating when you have inflation? We are inflating the monetary supply. We're inflating how much money is out there. So now, when there's more money out there, more people have the ability to spend. And when people have the ability to spend more money, that means more and more people are going to want to go out and buy a home. So now, if more and more people want to go out and buy a home, you're going to see more bidding wars. If there are more bidding wars on homes, well, that pushes home prices higher. This is what we've been seeing happen. When you have these bidding wars and home prices go higher, that then goes on the inflation report saying home prices have gone up so significantly, and then that also pushes up inflation, the inflation numbers that we see. So now when you see this higher inflation numbers, that's when the Federal Reserve Bank says, okay, we need to now raise interest rates to bring inflation down. That way we can cool down demand. So now when interest rates go up, mortgage rates go up, now people, before they go out to make an offer on a home, they think twice. You know what? I don't want to pay these higher mortgage rates to buy a home. Maybe we'll rent a little bit longer. Or maybe we won't move out right now. We're just going to stay here for a little bit. That way now, instead of having 40 offers to buy a home, maybe you have 10 offers or 2 offers or no offers on your home. And now what happens? Well, if there's less demand of people wanting to buy a home, you see less upwards movement in home prices, which means now if there's less upward movement in home prices, the inflation report says that home prices haven't grown as much, so you see a lower CPI number, a lower inflation number, which then signals to the Federal Reserve Bank that the higher interest rates are working. Well, what we've been seeing happen up until now is that the Federal Reserve Bank has clearly worked to increase interest rates significantly. I mean, over the last 18 months or so, interest rates have gone from essentially 0 to 5 and some change %. So interest rates have gone up very quickly. And that also means that the cost of borrowing money has gone up very quickly. And because it's happened so fast, we have yet to really see the full impact of the higher interest rates. Some economists and studies say that it takes 12 to 18 months for an interest rate hike's impact to be felt. We started raising interest rates approximately 18 months ago, which means we're really starting to see the impacts of the early interest rate hikes now, but we haven't seen the impact of the later interest rate hikes yet. That has yet to come. Now, what is the impact of lower demand and higher interest rates? Well, it goes back to understanding how does our economic system work? Our economic system runs on spending. We've done a ton of deep dives of this on Market Briefs, my free financial newsletter, which is why if you haven't joined Market Briefs yet, I highly recommend you do so. Yes, I am very biased because I created Market Briefs, but I also read Market Briefs every morning, and it's an easy way for you to stay up to date on what's happening with things like our economy, inflation, the housing market, the stock market, even crypto and the global economy. That way you're not blindsided about what's happening in the economy. We keep it unbiased. That way you can avoid all the sensationalism, and it's a really fun read. So if you haven't joined Market Briefs yet, it's completely free. And I got the link to how you can join my newsletter for free down in the description below. But our economic system runs on spending, which means the more money you make, the more money somebody else makes. When you make $100 and you go out and you spend all this money at Sweetgreens or Lululemon or Apple, these companies then make money. And when they make money, they have the ability to pay somebody's salary, and they have the ability to open a new store, and they have the ability to invest in new products. If you don't spend your money at these places, they don't have the ability to make payroll. They don't have the ability to hire more employees. And so when our economy runs on spending like this, the more money people spend, the more money businesses make, the more jobs that there are, and the more the economy grows. Well, what has happened over the last number of years was so much money was created. I read on NASDAQ's website just the other day that the total money printing between 2020 and 2021 was right around $13 trillion. That includes the COVID stimulus, that includes things like the infrastructure programs, and that includes all the other quantitative easing by the Federal Reserve Bank. That was about $13 trillion of money printing that happened, of new money creation that entered our economic system. That was the most amount of money we have seen enter our economic system in such a short period of time ever. It made the money printing after 2008 look like a drop in the bucket. Back in the 2008 crash, when we were talking about almost $1 trillion stimulus plan, people were losing their minds because of how significant $1 trillion of quantitative easing and stimulus would be. Now we're talking about multi-trillion dollars worth of economic stimulus. So just to kind of put it in perspective, it was a huge amount of money that was printed in 2020, 2021. So now all this money was created and it entered our economy. Now it went into people's hands in the form of stimulus checks and unemployment checks and some loans, which people spent at businesses, and then also went into the hands of businesses and corporations. Now again, businesses and corporations are also consumers. They spend money too. And so now when you have all this money out there, naturally, you're going to see a boost in the economy. We saw the economy boom in 2020 and 2021, even though we were coming out of the worst recession since supposedly the Great Depression. But no one really felt any sort of economic pain. So now all this money came into the economic system. The economy boomed. Businesses had so much money that they were expanding like crazy. We saw new offices being built, new virtual offices being built, new employees being hired, raises being given, bonuses being given, new departments being created, and people going out and spending money. Now, of course, the prices of things were rising, but it never really bothered people because people had more money, whether it was stimulus checks, unemployment checks, raises, or new jobs, or whatever it might be. It didn't really affect people. Now, of course, some people were, but on the general level, people still had the ability to spend more. And then in 2022, the party started to stop because in 2022, that was when we started to see the money printing go away and we started to see interest rates start to rise. The first interest rate hike started in 2022. And that was when we started to see that change. Now, it wasn't a very drastic change in the beginning, but that was when we started to see that change, where now the Federal Reserve Bank said we need to cool down demand. Now we are here in 2023, and the Federal Reserve Bank is very serious on trying to cool down this demand, which means they want demand for items to cool down, that way we can cool down inflation. Now let's think about what that means. If you reduce the demand for people to buy a home, that means you're going to have less people out there wanting to buy a home. Now, if you go from 40 offers to buy a home to 2 offers, that means you might not be able to sell your home for above asking like you might have thought. Maybe you might even have to eventually cut the listing price if you don't get enough offers in the first 30 days. And so if we see demand fall for items, now obviously that could impact the housing market in certain ways, but that would impact many different businesses. Because just think about it this way. If Chipotle is not seeing people go into its stores anymore, because the demand for Chipotle has gone down, what does that mean? That means they might not open another store, which means they might not hire more store people because, well, they're not opening more stores. Maybe that means they need to get rid of some of their research people because they're not going to be creating new products and new lines of things yet because they don't have the revenue to do so. And when you start to see that across the broader economy, that's going to have bigger impacts because if businesses see less demand, they're going to have to do something to manage the profit margins because businesses want to maintain a certain level of profit. And so now if demand falls, that means revenues fall. So if businesses see the revenues fall, they're going to have to do something because if revenues fall but their costs staying the same, that means their profits shrink. But that's not what we're seeing happen. We're not seeing revenues fall with profits or with operating costs staying the same. We're seeing operating costs rising. Now, of course, inflation impacts everybody, including businesses, which means businesses have to pay more money to get their things and to pay for the labor, which means if demand's falling, revenue's falling, while costs are also rising. Not to mention the fact that in 2020 and 2021, we saw the largest boom in corporate debt ever. Corporations used the 2020 and 2021 low interest rates to load up on debt. And why wouldn't you? These were the lowest interest rates that we saw ever. And so corporations said, how about we use this as an opportunity to go out and borrow more money? Many corporations did that. Now, some corporations used this more money to invest in their business, to use this debt to go and create more income. That's what you would want to do with debt, right? It's like going out, borrowing money to buy a rental property. That's what most people would consider good debt. But then some corporations also did the opposite. They did what many might call bad debt. They went out and they borrowed money to make their shareholders richer. Think of it like going to the Gucci store, not having the money to buy a $3,000 handbag or wallet or whatever it might be. And then instead of saying, you know what, I can't afford it, you just put it on your 0% APR credit card because the interest rates are so low. Well, many corporations did something similar. they use it as an opportunity to load up on cheap debt and then use this money to do a stock buyback or a one-time special dividend, meaning corporations took out huge sums of money at low interest rates and then used this money to give it away to their owners, their shareholders, to make the shareholders richer, which is great in the short term. You feel like you're rich, you got the Gucci handbag, or you got the money in your pocket, your stock price went up. But you're going into debt to fund something that is not income producing. See, if a business is going into debt to open up a new store or to open up a new manufacturing plant, that's an income producing asset. You're going into debt to produce more income. But when you go into debt to do a stock buyback, which raises the stock price, or you go into debt to pay out a dividend, that's not an income producing asset. That's going into debt to make your shareholders richer. And in 2020 and 2021, we saw a record amount of levered corporate buybacks. Levered corporate buybacks are when corporations use leverage, aka debt, to buy back their own stock. Now, okay, that's the first part of that. The second part of that is that corporations don't have 30-year fixed rate mortgages. What do they have? Adjustable rate mortgages. And most corporate debt is readjusting every 3 to 5 years, which means that in the next 24 months, we're going to see a huge chunk of corporate debt readjust. Well, now let's think about that for a second, because a few years ago, interest rates were the lowest rates ever. That's when corporations started taking out these huge sums of money. In the next 24 months, when interest rates readjust, if interest rates are higher, that means the payments on these debts will also increase. So now, let's go back to the diagram. Demand is falling. That's what the Federal Reserve Bank is working for, which means revenues are falling, unless corporations can find a way to increase revenue, but it's a little bit tougher when you're seeing a slowing economy. So revenues are struggling to rise or they're starting to fall. Costs are rising because, well, inflation, higher labor costs, higher product costs, but then you also have the higher debt costs because corporations don't have 30-year fixed rate mortgages, so debt servicing costs start to rise as well. This then puts a lot of businesses in a tough predicament, which is, okay, our costs are rising, our revenues are falling, we're going to have to make a change. That change is either we got to increase our revenue or we got to cut our costs. Again, like I just said, it's kind of difficult to increase your revenue when people have less money to spend. And people have less money to spend because inflation is so high. People have less money to spend because, well, people are seeing kind of the economy slow down. Eventually, if that continues, you're going to see less job opportunities. So people have less money to spend because of that. But then you also have, how do you cut your costs? And that's where one of the most accessible ways to do that is by letting some people go. Now, obviously, we've been seeing this happen in the tech sector and some other sectors now. And this is where now the question is, how much further will that go? Because it ultimately comes down to inflation. If the Federal Reserve Bank wants to bring inflation down to 2%, they're going to have to do more work in order to do so. What is that work? Raising interest rates. Well, what does raising interest rates do? It cools down demand even more. Cooling down demand even more slows down the economy even more. It slows down revenues even more. And this is that situation that we are just starting to scratch the surface of this happening. And it doesn't look like it's going to be going away anytime soon because inflation still has a way to go. And we still have to feel the impact of the higher interest rates. And now businesses are starting to see the impacts of, one, the higher costs and the debt servicing costs starting to rise. And this is something that over the next 24 months, we're going to see more and more of this progress. And while most people want to assume that everything is just going to be just fine, you have to pay attention to the red flags because the reality is this could create a lot of opportunities. It could also hurt people financially if you're not financially prepared. Now, you can look at what the Federal Reserve Bank is saying. The Federal Reserve Bank says that their prediction is that inflation is going to come down to 2% by 2025. Well, what does that mean for inflation to come down to 2% by 2025? That means between now and 2025, we're going to see above 2% inflation. Well, that also has its consequences because, like what I've been talking about, what does inflation do? Inflation hurts your buying power. And so if we continue to see higher than 2% inflation, that means more and more people are going to have less ability to spend. That also causes economic pain. So now if you kind of paint the picture of a triangle, we have three different things happening at the same time. We have the high inflation, which is slowing down the economy because high inflation hurts people's ability to spend. When you have high inflation, that means your rent is more expensive, your groceries are more expensive, so you have less money to spend on discretionary items. That means these other businesses have less money coming in because people don't have the ability to buy their products. Then on the second corner of the triangle, you have the higher interest rates. Higher interest rates are also hurting the economy because, well, the higher interest rates are cooling down demand. Higher interest rates makes borrowing money more expensive, which hurts people's ability to spend, right? In our economic system, you can spend money with the money you work to earn, and you can also spend money with credit. That's how money works in our economic system, because people don't just spend money based off of how much cash they have in their bank account. They spend based off of how much debt or credit they can qualify for. As interest rates go up, the amount of credit that's available goes down because less people are likely to borrow money, which means less spending is happening, which also cools down the economy. And then the third thing that we have happening, so we have the high inflation, the higher interest rates, is the slowing economy. And that's something that we're seeing happen right now. And this is where everybody has their question mark and their fingers looking right now is the economy going to slow even further? Now, of course, everybody has their own opinions and people don't want to create any panic or fear, but you have to understand this is what's happening. The high inflation is slowing down the economy, the higher interest rates are slowing down the economy, and we're just starting to see the impacts of all these things, and the economy is just starting to slow. Now, some people are saying that this is going to be contained to tech, but I don't want you to be blindsided by what's happening, because your job as a financially educated person is to be prepared for the worst. And prepared for the worst means when you have economic pain, being prepared to capitalize on opportunities. The reality, I'm going to be very honest with you. The reality is when you see economic pain, that also creates the opportunity to see the most economic gain. And the people that can get the most economic gain out of the economic pain are the people that are prepared and the people that are financially educated, which means you need to be financially prepared and educated. That means, number one, you need to have cash put aside to be able to capitalize on opportunities. You can see the greatest investment opportunity in front of you, but if you don't have the money to take advantage of it, it doesn't do you any good. That means, again, spending less, earning more, to have the ability to capitalize on opportunities. And number two, working to build that financial education, spending your time to learn, to build that financial education, because when you have these two things together and then you see an opportunity, you have the ability to capitalize on the opportunity. Now, the reality is somebody will capitalize on these opportunities. That has always happened every time we see an economic slowdown. There's a reason why market crashes and recessions create more millionaires than any other time. It's because some people are prepared for it and they're able to capitalize on the opportunities when they happen. Now the question is that going to be you? And you have to make the decision for yourself. You can hate it, you can complain about it, but this is the reality of the game. Now, financial education is obviously so important, and that's why I'm working here to help people learn about what's going on. That way you can finally capitalize on opportunities. But the reality is booms and busts are a part of our economic system. They have happened and they will continue to happen. We've seen a recession pretty much every decade for the last century. And to think that we're not going to see some sort of recession at some point in the future is just, it doesn't make any sense. It's based on no logic whatsoever. Now, nobody knows when it's going to happen, and I think that's the misconception is everyone's trying to time it. No one knows when it's going to happen. It will eventually happen, but this is where you want to be prepared and pay attention to all the things that are happening, because unlike previous recessions, we have some different situations now, such as the higher inflation, because prior to pretty much every other recession in modern history, the Federal Reserve Bank used to be able to create inflation to pull us out of the recession, right? When you see the economic slowdown, the Fed would just cut interest rates or print money and inject it into the economy to stimulate the economy, and you didn't have to worry about inflation because, well, inflation wasn't a problem then. But today, inflation is already a problem, and now we're starting to see the economy slow down. So the Federal Reserve Bank doesn't have the same ability to inflate the way that they did before. Can they? Absolutely. The Fed can cut interest rates and print money and throw it into the economy, but the consequences of that are much more apparent now because the inflation genie has already come out. And so this is where you have to be cautious and understand this and understand the risk factors, because this can also create the most opportunities. The most potential economic pain can also create the most potential economic opportunities. And I know this makes a lot of people upset when I say this, but this is the reality. I mean, you can be mad at gravity for existing, but the best thing for you to do is understand gravity and learn how to use it to your advantage. This is what's happening in our economic system. You can hate me for telling you, or you can understand it. That way you can use it to your advantage, because I want you to be able to build wealth. That way you can take care of yourself, your family, and your community. It is your duty to become financially educated. That way you can bring that wealth for yourself and your family. Because it's you who's got to pay for your bills. It's you who's got to pay for your kids' college, or just you who's got to pay for building that financial foundation for your family. And so if you want to be able to do that, you have to get financially educated and get prepared. And that means understanding what's going on. That way you can capitalize on whatever the opportunities will be your way. Now, of course, I'm working to keep you updated here. If you haven't joined Market Briefs yet, do so. Briefs.co/market. It's an easy way to stay up to date, but this is where you need to make sure that you're working to, number 1, spend less. Number 2, earn more. And then number 3, invest like crazy. When I first started learning about entrepreneurship and I first started seeing success in entrepreneurship, this is years ago now, I was so obsessed and I was so excited because I finally, for the first time, started making decent money. And if you want to quantify decent money, it was probably $200,000 or $300,000 a year as an entrepreneur from my own